Hello, I'm David Hardesty, and this lecture is an overview of U.S. tax rules for the U.S. taxation of non-resident alien individuals and foreign corporations. The objectives of this lecture are to understand the following. The basic principles of taxation based on the source of income versus taxation based on residency. The basic U.S. scheme for taxing non-resident alien individuals and foreign corporations. And the impact of U.S. tax treaties on the taxation of non-resident aliens and foreign corporations. There are two basic ways in which tax is imposed by a country. One is on the basis of residence, which is used by the United States to tax the worldwide income of its U.S. corporations, citizens, and resident aliens. Under the regulations, all citizens of the United States, wherever resident, and all resident alien individuals are liable to the income taxes imposed by the Code, by the U.S. Code, whether the income is received from sources within or without the United States. The same rule applies to domestic corporations. The other is on the basis of source, meaning a country exercises the right to tax income if that income has its source in the country. This is the basis for the United States taxation of U.S. source income of non-resident alien individuals and foreign corporations and other entities. Here's an example of residence country taxation of worldwide income. Hidalgo is a Brazilian citizen living in the United States. He has a green card and is a permanent resident of the United States. As a U.S. resident, he is taxable on his worldwide income. This is the case even though he is a citizen of Brazil. Here's another example of residence country taxation. Jones is a U.S. resident with rental income earned on a real property located in country X, a foreign country. The income from that property is taxable in the United States due to the fact that Jones is a U.S. resident. Here's an example of source country taxation. Rodrigo is a Spanish citizen and resident who has never been in the United States. However, he owns an interest in rental real property located in Minnesota. He is taxed in the United States on the income from that property because the source of the income is the United States. Foreign persons are taxed in the United States on business income sourced in, that is, originating in, the United States. The following outlines taxation of such income under U.S. domestic tax law. A foreign person's income that is effectively connected with a U.S. business is taxed in the same manner, using the same rates, as income earned by a U.S. resident. The foreign person recognizes U.S. source gross income and reduces that income by allocable deductions. The result is taxed based on regular U.S. tax rates either at Section 1 for individuals or Section 11 for corporations. For foreign corporations doing business in the United States, an additional branch profits tax is imposed on any income of the company after paying income taxes that is not reinvested in the United States business operations. Here's an example of effectively connected income. Foreign Corp is a Country X corporation with a branch office in the United States through which it sells product X to U.S. customers. No tax treaty applies. Foreign Corp is engaged in a U.S. trade or business, and its U.S. sales are effectively connected with that business. Accordingly, it files a U.S. tax return, Form 1120-F, to report the income from this business. Income from the business is determined in the regular way. The corporation reports gross receipts from U.S. sales and deducts related expenses. Net income is taxed at corporate tax rates applicable to U.S. corporations. Now let's turn to the taxation of foreign persons on non-business income. U.S. source income that is not effectively connected and which is interest, dividends, rents, royalties, and other fixed or determinable annual or periodic income, that is, non-business income, is taxed at a flat rate of 30% with no deductions allowed. Some non-business income is specifically exempt from tax. This includes, for example, some U.S. source interest income, and some capital gains. However, an exception exists for U.S. source gains on sales of real property, which are taxable. Here's an example of the taxation of non-business income. Foreign Corp is a Country X corporation that is not engaged in a U.S. business. It receives royalties from licenses of patents to U.S. companies. No tax treaty applies. Foreign Corp is taxed at a rate of 30% on the gross royalty income. No deductions are allowed in determining the amount of income subject to this tax. Now, let's take a look at the effect of a tax treaty where a foreign person is resident of a foreign country with which the United States has a bilateral income tax treaty. Business income is taxed in the United States under a U.S. tax treaty only to the extent it is attributable to a permanent establishment in the United States. If there's no permanent establishment in the United States, then U.S. source business income is not taxable in the United States. In general, if the income subject to tax in the United States as determined under the tax treaty is less than it would be under U.S. domestic tax law, the foreign taxpayer may, but is not required to, invoke the treaty to reduce the tax. A permanent establishment is a fixed place of business through which core business activities are carried out. A permanent establishment does not include fixed places of business that serve only auxiliary or ancillary roles in the business. These latter include, for example, warehouses used only to store merchandise. Non-business income, including dividends, interest, rents, royalties, and other fixed or determinable annual or periodic income, which is not attributable to a permanent establishment in the United States, is taxed in the United States under the rules for non-business income discussed earlier. However, a treaty may eliminate the income subject to tax or may reduce the tax rate. Here's an example of taxation of income attributable to a permanent establishment. Foreign Co. is a French corporation with a branch office in the United States that is considered a U.S. trade or business. In addition, the office is considered a permanent establishment. In this case, the amount of income attributable to the permanent establishment is less than the amount of income that is effectively connected. Accordingly, instead of being taxed on the business income that is effectively connected with the trade or business, Foreign Co. is taxed in the United States on the business income attributable to the branch office only. Here's an example of the effect of a treaty exemption on the taxation of non-business income. Foreign Corp is a German company that licenses patents to U.S. companies. Under Article 12 of the U.S.-Germany Tax Treaty, a German resident is not taxed in the United States on U.S. source royalties. Without the tax treaty, Foreign Corp would have been taxable in the United States at a rate of 30%. Under the treaty, it is not taxable at all. Here's an example of a taxpayer with U.S. source business income, but no permanent establishment in the United States.
Foreign Corp is a UK corporation that sells tools to U.S. customers. It does not have an office in the United States. However, its salespeople regularly make sales calls on U.S. companies. In this case, these salespeople cannot make contracts on behalf of Foreign Corp. And for reasons we will discuss in week 3, this lack of contract power means that Foreign Corp has no permanent establishment in the United States. Even though it may be engaged in a U.S. trade or business through the regular presence of its salespeople, because it does not have a permanent establishment in the United States, its sales to U.S. customers are not taxed in the United States. The last piece of our overview of the taxation of foreign persons is withholding. Foreign persons, including non-resident aliens, foreign corporations, and sometimes foreign partnerships, are subject to a vast system of income tax withholding on much of the income that is subject to U.S. tax.
%30 withholding is required for payers of most non-business income, such as interest, dividends, rents, royalties, and other fixed or determinable annual or periodic income. Income tax withholding is required for a disposition of a U.S. real property interest by a foreign person, which includes a direct ownership interest in real property located in the United States, or an interest in a corporation that holds such real property. Withholding is ordinarily at 10% of the amount realized by the transferor. A partnership, whether foreign or domestic, must withhold tax on income distributable to foreign partners to the extent that the income is effectively connected. Tax is withheld at a rate of 35%. Moreover, under certain circumstances, a partnership may be required to withhold the 30% tax on non-business income distributable to foreign partners. Here's an example of withholding on non-business income. Albert is a citizen and resident of Country X who received dividends from investments in U.S. domestic corporations. He is not engaged in a U.S. trade or business, and no tax treaty applies. The paying agent must withhold tax at a rate of 30% on dividends paid to Albert. Here's an example of withholding on the disposition of U.S. real property. Hickman is a Country X resident who sells real property located in Nevada. He is a non-resident alien. His net proceeds from the sale are $10,000, and his cost is $95,000 for a gain of $5,000. This gain is taxable in the United States. However, despite the fact that Hickman's gain is only $5,000, the transferee must withhold tax of $10,000 or 10% of the amount realized. If instead of selling real property for $100,000, Hickman sold stock in a domestic corporation that was a U.S. real property interest under U.S. tax law, then the result would be the same. That is, the buyer would have to withhold $10,000 from the sale. Here's an example of partnership withholding. Partnership X is a U.S. partnership that earns $100,000 of effectively connected income. Amelia is a Country X partner who owns 10% of the partnership. Amelia is a non-resident alien. The partnership must withhold 35% of Amelia's 10% distributive share of effectively connected income, or $3,500.